All right. Good evening, everybody. Thank you all for joining. This is the Industrial Real Estate Investing Educational Webinar. Today is Wednesday, March 13th, and we're going to be interviewing Andrew Dressel, a host on this Zoom series. And also an attorney, real estate attorney in the industry, and he's going to be going over educating about the kind of syndications, the ins and outs, and everything to look out for if you're an LP, and as a GP, what you should be, what your goals should be when you're structuring these deals. So Andrew, without further ado, why don't you take it away? Thank you very much.
Thank you, John. Yeah, I've been out for the past couple calls with some professional obligations, and I'm glad to get on here and speak about a topic near and dear to my heart, which is securities law. As John said, I am an attorney in New Jersey, and a large portion of my practice is advising potential securities issuers in the commercial real estate space. So I want to talk about the rules you have to keep in mind when you're issuing securities, and this applies beyond just the industrial warehouse space. I mean, these are the rules for all commercial real estate syndications. They're the rules for securities overall. And I also want to talk about a few topics that I think are a little more timely, and that I think folks have to be a little careful about and keep in mind as they're pitching their syndications. Before I get started, I do have to put this disclaimer out there. This presentation is not legal advice. If one day you were to find yourself on the wrong end of an SEC investigation, please don't tell them that Andy Dressel said this was fine. I heard it on a webinar. This does not create an attorney-client relationship. I'd love to have attorney-client relationships with all of you. If you have something you're working on, I'd be very happy to have a chat. But this webinar does not give rise to an attorney-client relationship. So a security, what is it? And this may be very basic for some of you, but for others, maybe this is your first time sort of dipping into issuing securities. And the SEC, along with the Supreme Court, developed a four-part test on what constitutes a security back in 1946. And this basically remains the state of the law today. So it involves an investment of money in a common enterprise. So we have a group of investors working together. They expect profit. So this is not a nonprofit entity. And this is the big catch. And this is what gets you from a normal investment into the realm of securities regulation, that people are going to be profiting from the managerial efforts of others. So what does that mean? So many of you are familiar with joint ventures, where you and maybe 3 or 4 other people would get together, pool money, buy a property, and you all have some sort of management interest. Now, that may involve shares of stock in a corporation that you create, or membership units in an LLC you create, but those shares and those membership units are not securities. What becomes securities are when you start seeking out investments from people who won't be managers, right? They are going to be passive investors, which means that's what most of you are going to be doing. You are going to be selling securities, and you are subject to securities regulations. And there's 2 types of securities, essentially. There's registered versus unregistered securities. Most of you are familiar with the idea of registered securities. If you own shares in a publicly traded company, you own shares in Microsoft, you own shares in Apple, you own shares in ExxonMobil, those are registered securities, right? They hire underwriting firms, they produce audited financials, they produce those audited financials to the SEC, they make quarterly reports to their investors, they make annual reports to their investors. It's a very onerous process, and it's really for companies that are looking to be very, very large public companies. I don't think that's anybody here. That's not what we're doing. We are going to be going into the realm of unregistered securities. And that's where people get in trouble, because there's a very strict set of regulations regarding unregistered securities designed to protect investors. And there's two regulations basically that people offer unregistered securities under. The first is something called Reg A. And Reg A is still pretty onerous and still requires a lot of work. So you have to create what's called an offering statement and provide that to the SEC. And that's going to, again, get into the financials and get into the nitty gritty of the company. The benefit of that is you can market that stuff to pretty much anybody, because you're going through something that's almost like the registered securities process. You're going to have regular reporting, and if you're doing one-off projects, Reg A is probably not the way to go, right? If you have a warehouse in Texas or Georgia or whatever, and you want to raise $5 million, and that's your project right now, Reg A is not the way to go. Could make sense if you're looking to form some sort of fund where you're going to have investors sort of have money sit there, and then you'll dip into that pool of funds when you're ready to make a project. Then Reg A could make some sense. But for most of us here on this call, Reg A is not something we're going to be looking to. We're going to be looking to what's called Reg D. Reg D is a much simpler process. In Reg D, you just file a notice with the SEC, Form D, that says, hey, I'm going to be issuing some unregistered securities, just letting you know. But it also means you can't just market it to anybody. Okay, the marketing is not available to the general public. We're going to see that, again, there's some very strict requirements that need to be followed when you're making Reg D offerings. But this is what, if you are going to be in the business of doing syndications, if you already are in the business of doing syndications, this is what you're doing, is Reg D filings. And now under Reg D, we've got three types of filings here. The first are 504 filings, which is probably not something most of you are familiar with. The Rule 504 filings, you have to register in a state that has some sort of publicly filed registration statements. It limits the sale of securities to $10 million over a 12-month period. And it cannot be what's called a blank check company, where you basically say, I'm starting a company, but it doesn't really have a purpose yet. Rule 504 is mostly for startups, essentially. You want to get some seed capital in a startup, you might look to Rule 504. We are going to be, you folks, and when John and I do stuff, we're in the realm of Rule 506, and really 506B. 506B, again, no general solicitations, no general advertising. Okay, you cannot put a banner ad on a website saying, hey, check out my investment. You cannot, go on Facebook and just, we'll talk about Facebook in a little, but you can't just post it to everybody, hey, I've got an investment, why don't you all check it out? There's very strict rules, again, about the marketing with 506B offerings. You can offer 506B offerings to an unlimited number of accredited investors. What is an accredited investor? Well, there's a lot of definitions, but the one that's most important probably for most of you has to do with either income or net worth. So if you're talking to individuals, if you're talking with a married couple that files jointly, their income's going to have to exceed $300,000 over the past 2 years. It's a slightly lower amount for individuals. Or they can pass the net worth test, having a net worth in excess of $1 million, excluding the value of their primary residence. You can also sell 506B offerings to 35 sophisticated investors. Now, what is a sophisticated investor? A sophisticated investor, the definition is a touch nebulous, but it's basically somebody who has invested in this type of product before. So If we're talking about membership units in a real estate LLC, somebody that has some sort of experience investing in real estate. You are supposed to make additional disclosures, though, to the sophisticated investors. They should be getting some sort of financial statements or something. Now, oftentimes we don't have audited financials yet because it's a brand new company. But you should be doing your best to make full disclosures to the sophisticated investors. Under 506B, you don't need to be registered in any state. And most importantly, or not one of the most important things, the investors can self-certify on whether they're accredited or not. So it is not your responsibility in a 506B offering to investigate your investors and go through their tax returns or bank statements or statements of assets, whatever. It's on the investors to self-certify. Then we have 506C, which some of you may be familiar with. In 506C, you can engage in general solicitation, right? You could send out an email, just a blast email, including to people that you don't know, informing them about this. I get, for example, emails from venture capital funds that I don't know the people at those venture capital funds, but they're doing a 506C. They got my name off of some mailing list, and boom, I'm getting emails from them. That's fine. Only accredited investors can invest in the Rule 506C offerings, and the issuer in this case has to take steps to verify that the person is an accredited investor, right? So you're allowed to broadcast to the public. You can broadcast to people you don't know. But if they come by and say, hey, I'm an accredited investor, I'd like to invest in your business, you now have to take an affirmative step to verify their status. And that usually involves hiring some sort of third-party service that will review tax returns or financial statements or something like that to verify. Now, when you're doing an offering, what documents do you need? There's three really important ones. I mean, you may have more than this when you're making your offering, but these are sort of the bedrock. And the first is the private placement memorandum. And this is a document you would hand over to your investors. It'll discuss the business plan, how you're planning on making returns, and most importantly, it will disclose risks. The risk disclosure is very, very long. I'm sure you've all had PPMs. You look at the risk disclosure, it's 15, 20 pages. And if you are a GP, you really, really need that because you need to disclose all the risks you can, because that way, if the deal doesn't work and your investors are unhappy and they come back and they start hollering at you about securities fraud and they're going to sue you, this and that, you say, well, hey, if you read the PPM, I told you this was going to be a risk. So it's really, if you're a GP, this is how you cover yourself, is with the PPM. If you're an LP, read these things carefully. Now, I had a phone call this morning with a client of mine, pretty sophisticated investors. They're LPs on a deal, on a syndication. They are not happy with the returns. They called me up. They want to talk about securities fraud. Do we have a lawsuit? They told us that they'd be able to raise this much in equity. They didn't do it. They had to borrow it as debt instead, and it's hurting us. I said, well, if you look at the PPM, they told you that was a risk. So you really cover yourself with the PPM. The operating agreement is the actual ownership agreement of the entity that the people are buying into, right? Everybody's essentially buying membership units in an LLC, and the operating agreement is what sets that forth and what rights each member has. I mean, usually you're going to set it up with a couple classes of membership units, and the managers are going to have a great deal of discretion. And finally, there's the subscription agreement, which is where the person actually turns over the funds. So those are the things you're going to see from your attorney if someone's preparing documents for you for one of these syndications. So a few topics that I think are timely that I want to cover. And the first is social media. when you're soliciting investments. Many of us that are GPs use social media to generate interest in our projects. You may make a Facebook post. You may send out an email to a mailing list that you've created. And the question is, how proper is that really, especially if you're doing a 506B offering? And the SEC has said that 506B offerings should only be made to individuals with which the GP or somebody acting on the GP's behalf, right? So you've got a fundraiser on your team who's raising funds on behalf of you. They should only be making these offerings to people with which they have a substantive and pre-existing relationship. So what is a substantive relationship? A substantive relationship is one in which the issuer has sufficient information to evaluate and does in fact evaluate a prospective offeree's financial circumstances and sophistication and determining his or her status as an accredited or sophisticated investor. So you should understand something about your investor. Or if somebody is raising money on your behalf, ask them, do you know this person? Do you know if they are, they understand what they're doing? Do you know if they're really accredited? Because that's where you can get in trouble is if nobody's doing that, nobody has that kind of relationship and is asking those kinds of questions. Pre-existing relationship. So somebody on your team should have a pre-existing relationship with the investor, and that is a relationship formed prior to the commencement of the securities offering. So it can't be that you met them after I said, hey, do you want to buy, into my warehouse in South Carolina? Somebody on your team should have a pre-existing relationship with that person. Now, transitioning from that, what about, networks of investors? So many of us here are part of some sort of mentorship, networking program. We may be on a Facebook group together, whatever, and you don't necessarily know all those people very well, right? So you're in a group, you met at a conference, there were 300 people at the conference, everybody likes to post every day, but you don't really know each other. Is that good enough for 506B? And the SEC has looked at it and basically said people who meet through these sort of networks of investors, especially one where there's been some sort of vetting process. So, Warrior Group, for example, there's a vetting process to get into that. You can assume that those people are experienced and sophisticated enough to have the financial experience to make these kinds of investments. So meeting through these sort of networks of investors, that is sufficient to allow for a 506B offering. The other thing that's really tricky that people need to keep in mind is when you have investors who invest through entities, right? So people will invest through a trust. They'll invest through another LLC they own, right? And then self-directed IRAs. That's become more and more popular. You have your investors are coming in through self-directed IRAs. Keep in mind for entities, for an entity to be an accredited investor, it needs to have $5 million in assets. Okay, so you need to ask questions. If somebody comes in, your friend says, I want to invest, but I want to invest through my company that I own. Well, now you got to ask them, well, what's your company's balance sheet like, right? It's not when they're coming in as an individual and they only need 1 million in net worth. Now they got to have 5 million in assets if they're doing it through the entity. So you should have that conversation with them. Self-directed IRAs, little bit different. The SEC has issued clarifications on this. For the self-directed IRAs, you look to the decision maker for the self-directed IRA. And so you would check again whether that individual meets the asset or the income test or some other way of qualifying as an accredited investor. So the self-directed IRAs are a little different, but if people are investing through trusts, they're investing through other LLCs, you need to have a talk with them about whether that entity they are investing through meets the asset test for investment. Yeah, and this is a recent SEC action letter I saw. So I guess the company Pick Renegade Properties LLC. They're doing syndications. They raised $50+ million from 140 investors. They did it 506C, right? So they could do general advertisements, but they were required to verify, and they didn't do it. And where they really tripped themselves up were the entity investors, right? They didn't ask if somebody was investing from a company. They didn't ask, well, who's the decision maker for the company, right? Or is it just you, or do other people own equity shares? And what's the balance sheet like? You know, if people invested through a pension plan, they didn't ask, is this a self-directed pension plan, or is this from a company? Who's in charge of directing the pension plan trades? They didn't ask all sorts of the trust questions, irrevocable, revocable, whatever. You really have to get under the hood if you are having people invest through entities to make sure they are doing it the right way. In this case, they ended up with a $400,000 penalty. Now they raised 54 million. So 400,000 is not a huge number in comparison to the 54 million, but I'm sure it had an effect on their balance sheet. So understand your entity investors. Even if they're self-verifying, I still think you are required to ask some basic questions about the entities. So that's everything for today. I've got my contact information up there. If anybody is interested in me helping with an offering or something you're working on, please just text or call my cell 914-374-1548, or you got my email there as well. Also, John, reach out to John if you have questions about this stuff. He's quite experienced, and he'll put you in touch with me if you want to discuss further. But thank you all.
Thank you, Andy. That was an incredible overview. Tons of valuable information there. Does anyone have any questions that they want to ask about syndications, about deals, about anything on this topic? If you want to post it in the chat, or just raise your hand and come up and ask the question. If not, I have a couple questions.
All right.
It looks like everyone says thank you, Andy, and great job.
Thank you.
So 506B versus 506C. 506B is that is 35 unaccredited investors, unlimited accredited investors, and you have to have a substantive relationship
right
with the unaccredited investors. The I would assume the kind of smell test of a accredited investor doesn't really apply to those investors, right?
Well, I mean, look, you need to have a conversation, right? I mean, that's what it means to have a substantive relationship with someone,
Yeah.
right? If someone's investing in your product, even if they're self-verifying, you should at least talk with them and feel that yeah, they're accredited, right?
Okay.
I mean, you don't want.
What I'm saying is, I think the accredited investor, the accredited investor smell test, if you will, really applies to 506C, where you're going to be taking more investors that do enter as an entity, and you really have to vet them to make sure they have the $5 million in assets.
506C, you are required to verify. I mean, the obligation is on you to do the verification. I mean, there's lots of third-party services that are out there that do it, and that's how most people do it, right? I mean, when I've had, for example, venture capital funds call me up and I have a conversation with them, they'll refer me to somebody who does the income. I turn over my tax returns, whatever, and they do the verification, and then they tell these people, yeah, you know, he's an accredited investor. You guys can keep talking. The big thing though, and Trevor put a question here again. The entity investors are where people really get into trouble, right? Because not only the threshold's higher, right? So now we're talking about 5 million instead of 1 million. But the ownership structure of these things is not always clear. And for example, I've had projects where people invest through a company they own, right? They hear that real estate has all these great depreciation benefits. I'm going to get all these tax write-offs, and they come in with their company and they want to invest through their company because they think they're going to get these great tax write-offs or whatever, right? Make sure that they have the authority to do that, right? What if they're one of 3 partners or one of 3 shareholders in a small company, right? Talk to them and make sure that they are authorized to do this. Because the last thing you want is the other 2 shareholders to turn around one day and say, what the heck? We just lost so much money. And he didn't have the permission to do that. And you didn't even talk to us. So ask that follow-up question, the trust, who's the grantor on the trust? You have to, when people will come to you and say, I want to invest, but I can't do it individually. I got to do it through a trust. I got to do it through my company. I got to do it through my SDIRA. You need to ask follow-up questions about, who's got the authority. They may think they have an SDIRA, but they really don't. I mean, these are the questions you got to talk with your investors about.
No, that's mainly on the 506C. Again, 506B, it's totally different.
It is and it isn't. I don't think you're I know 506B is self-certified, but I don't think you're totally absolved. For example, if someone is investing through a company, right? That's something that comes to mind right away, right? They're investing through their LLC. I think it's prudent to at least ask them, are you the guy that gets to call the shots on this LLC? Are you the majority owner? Do you have a partner? Because that's where you're going to run into problems, right? Is they go to do their taxes the next year, their accountant tells them, oh, you actually, your company lost $10,000 on this investment last year. And the other partner just goes crazy and says, oh, you didn't have authority to do that. And then they call you up and, they're talking about lawyers and everything else. And even if ultimately it doesn't end up, with the SEC hitting you with a penalty, anytime people start talking about lawyers, it's going to cost you money out of your pocket, right? Because you're going to have to talk to a lawyer too. So even if, ultimately it doesn't end up with you getting in trouble, the fact that you're having these kinds of conversations is already a cost, right? Because now you've got an investor who's unhappy, you got people sending letters from lawyers, whatever. It may all cool down, but it's going to be a headache for at least a little while.
Thanks, Andy. It looks like there's a couple questions about 506B. Good rule of thumb is 3 times recently.
Yeah, I mean, that's a rule of thumb. I was looking at the 506B regulation itself again today. There's nothing that says you need to, that has 3 or 30 days of a cooling off period. I mean, I think it's just, look, you need to be able to say that you had a relationship with this person previously, or somebody on your team had a relationship, right? Somebody who's doing fundraising on your behalf, right? So you could be the person who underwrote the deal and is spearheading the deal, and you've got fundraisers working with you as part of your GP team. Somebody on your team needs to know these people. I don't know that you need a cooling off period necessarily. You can keep your leads hot. I don't think there's any issue with that. But you should, again, just, even though it's a self-verified process, if you want to have had a substantive relationship with these folks for sure.
Be good buddies.
Yeah. I mean, so in terms of monitoring the SEC is not, right? The SEC does not get involved in this stuff basically unless something bad is, especially the types of investments we're talking about, right? I mean, let's be real here. Most of us are not big enough to be on the SEC's hit list. Uh, what happens is you have an LP who gets upset for some reason, right? That's where the problems arise. And they start yapping, and then they call a lawyer who maybe doesn't know a whole lot, and they start yapping, and that's where you get into issues. So nobody's really monitoring, you know, these things. No, if you put together a syndication and you raise $4 million from 20, LPs, SEC is not looking at that. That's just not enough to get on their radar. But it's if things go south, and they have a friend who's a lawyer who they talk to, who calls somebody else, and that's when problems arise.
The Andy, the SEC is a complaint driven organization, right? So if they get
Yeah,
a bunch of complaints about an operator, that's when they're gonna start penalizing
right. So
people.
you get LPs who are not happy with their returns, or something's happened that's a little different from how they understood the deal. And yeah, somebody starts calling, or they call, they say, oh, I've got a friend whose brother-in-law is a lawyer, I'm going to call him. And they call him, and he calls the SEC, or whatever. That's where the problems arise. So the big thing: keep your LPs happy. I mean, that's that's the number one
Updated,
rule in this business, right?
updated, happy, and yeah, you'll be good. Well, um, it looks like that's what we got. So um I think we want to thank everybody for joining us tonight. I'm gonna stop the recording, so thank you for watching the recording. And